In this video, I'm going to teach you the one option strategy that pays my bills every month and makes me about $3,500 a month on average. It's the one that has allowed my wife to retire as a public school teacher, which is awesome. And the same strategy that I've taught to over 10,000 other traders, most of which are now able to supplement their income, and some even have fully replaced their 9-to-5 income. So here's the plan for this video. I'm going to walk you through proof to prove that I'm not just BSing you, and I'm going to walk you through the strategy, the back test, the entry, the exit, all the rules that you know exactly how to place it, so that by the end of this video, you know exactly how to implement it. Then I'll show you risk management strategies so that you can actually know, hey, if a crash happens or if a volatility spike happens, you know how to protect your account. And then a bonus is I'm going to show you how to automate it so it's completely passive. So let's dive into the first part. Let me make my face smaller. Let's go to my broker. Let's refresh the page to prove it's true. I do a second to reload here. And then we're going to do year to date. And then again, we can see here I've made about $8,500, which is great. So that's about $3,500 a month based on where we're at so far this year. And so that's awesome. Now, what I'm going to be getting into is the strategy that I'm using and that I've taught to others. Now, this is called a strangle strategy, but there are a few things around it that make it very unique. Okay. And so here's the back test of it. You can see here it's a very reliable and consistent strategy. Obviously, there are some points where it dips down, and that's why I'll be teaching you some very important yet simple risk management approaches and strategies that can cut your risk down dramatically. And so again, this is the strategy, the strangle strategy. You can see here it makes about 7% a year. But again, I trade this on futures, so I actually get about greater than that. I'm much greater than that. But anyways, that's how we're doing it. 97% win rate. It's a pretty great strategy. So how do we actually trade? Okay, first let me explain what a strangle is for those who don't know. Okay, so if the stock is trending up like this, or in my case, futures, and it's doing this, a strangle is betting that a stock will stay between two levels. So I'm selling a put down here, which bets that the stock will stay above this level, and I'm selling a call up here, which is betting the stock will stay below this level. So as long as the stock stays between these two levels, no matter what it does, goes up, goes down, goes sideways, I'm still going to make money on this trade. And so that's how a strangle works. Now, if you're actually entering the trade, this is what it looks like. You're going to be selling a call. So again, I sell one call, and I do this at the 5 delta level. This is very far away, which you'll see in a second when I show you how to do this in the broker. But this is because in general, the market tends to trend higher. And so if it tends to move higher, I should give myself more room to the upside so that this level doesn't get hit, because if it does, then I lose. So 5 delta pushes me higher, so I have more room to the upside. Then what I do is I sell the put, which is this downside one, at 10 delta, so I come a bit closer so I can collect more money. Why? Because in general, the market trends higher, so it's okay coming up a bit closer. So legit like that, the 5 delta, 10 delta. Now, what do I do this? I do this about 90 to 120 days out. I prefer 120 DTE because it lowers my risk, allows me to collect more profit, and increases my win rate. So 120 DTE is my sweet spot for this trade. And I typically trade this on ES. Again, this is a big boy contract, which you'll see in a second. But again, if you want to do it on smaller things, you can do SPY, or if you want to do futures, you can do MES, but be careful of the liquidity on that. But this is how this trade is structured. Super simple, just like that. Now, how do we enter the trade? You're going to enter on a consistent frequency, okay? So that means once a week, twice a week, once a month, whatever your account can allow, okay? Let's say you have a $100,000 account. You should be trading this, yeah, that's just for easy math. Let's say you should be trading with no more than 30% of your account. That means that $30,000 can be allocated to trading. If that's true, and let's say in this example, I'm using ES. ES costs $5,000 per trade. Again, this is a larger contract size. That gives me 6 trades that I could be in at once based on this account size. So again, 6 trades. That means I could probably do 2 trades a week. Why? Because this trade closes in about 2 weeks, which means when I open the trade and when I close it for my take profit or stop loss, that means that I'm going to be about in the trade on average about 2 weeks. So I can enter one trade on Tuesday and another trade on Thursday. And that's when I enter. Again, if I prioritize red days and entering after the market has dropped, this is going to give me a higher win rate and better profits. Sweet. So this is how I structure the trade. This is how I enter the trade. Now, how do I exit the trade? I do a 25% take profit. I might be wondering, that's quite small. Why do I do that? Because again, By having a smaller stop loss, I'm able to close my trades faster. That's why I'm able to close it every 2 weeks. And that way I don't have a lot of trades on at one time, because if the market were to drop or volatility were to spike, then I'm going to have a ton of trades that are now losing instead of just a fewer trades. So this allows me to turn over my trades faster. Then I do a 300% stop loss just to protect my downside in case of something crazy. So this is how I structure the trade. This is how I enter, and this is how I exit. Putting all these together is how you get something like this. But if you're wondering how to enter into the broker, it's actually quite simple. Go to the broker, put in the symbol that you want to use. For me, I use the S, and go to the options tab. Look at the middle. This will show you the days out you're looking at. Again, you're going to go to about 120 days. So you see right here, 121 is the next closest. Then I'm going to have Delta enabled here. So I'm going to look for a Delta. And then I'm going to look for a 10 Delta on the right side, because the right side's puts. So I'm going to sell this 10 Delta right here. If it lets me. Sell the 10 Delta. Maybe not. Let me refresh a second. So I'm going to sell this 10 Delta right here. And that allows me to sell it. Then we go to the left side, which is the calls. What I'm going to do here is I'm going to sell the 5 Delta. So 5 Delta is going to be 0.05. I'm going to sell this one. This gives me a total credit of $51.75, which leads to a max profit of $2,580, which is great. And I'm putting up about $5,600. But we have to keep in mind that this trade, although that's my max profit, I'm still not going to hit that whole amount because I do a 25% take profit. So that means this trade, if it hits the winner, will make me $650. That sounds great, but we need to consider how much money am I putting up to make this amount? So if I divide that by how much money it takes, which right now is $5,600, that means I'm making a 12% return on my money. Can you guys see that? In 14 days, I can make a 12% return. That's how awesome this is. Because again, it beats out banks, beats out most things, and it still has a relatively high win rate of 78% if we just let it go all the way through. But by doing the 25% take profit, it boosts our win rate up into the 90 to 95% zone, and we're making a 12% return on our money in that time. This is why I love futures. So now that we know the upside and how it's done, we must consider the downside. What is our risk when we're doing this? So what is our risk management strategies? And that's exactly why I wrote this book. I'll never worry about volatility again. You can get a free download to the book down below. Again, this will give you access to everything, but there's a checklist in the book that walks you through all the things you can do to eliminate risk as an option seller to make your returns more stable and more consistent. But I want to show in this video the Bollinger Bands and how I use that. So this is just one tactic from all the ones you can get in this book, linked for free down below. Anyways, when you're looking at a trading chart, what you're going to do is you're going to go into the indicator section. You're going to type in Bollinger Bands. You can do this no matter if you're looking at a broker or Yahoo Finance or TradingView, whatever. You add this to your chart. Most people see it like this, but we want to make one big change. We're going to come into here. We're going to change the settings from a 20 to a 200. When we do, this gives us a better understanding of how the market is performing. So what does this show? Between the green and the red, this highlighted blue the highlighted blue area shows us where the market should be trading. So if it's outside of this range to the upside, then that means it's likely to pull back inside. So you can see here when we break out, it's likely to pull back. When it gets close to this red zone, we pull back, right? Same thing if we break to the bottom. If we break to the bottom, it's very likely to push up. So how can we use this as an option seller? This means that we can sell strangles up into the point that it's above this level or below this level. We don't want to see a very fast move in either direction as a strangles trader, right? Because we have two sides, and if it breaks either side, then we lose, and we don't want to lose. And so that means the best time to do this trade is when we are inside the middle of this zone. That's when the market tends to be slow moving or whatever. And the second we start to get close to this red line or this red area, you want to start slowly taking off trades. You have less positions on. So if it does turn around, you have less risk. But also you want to start putting on hedges at this point. When you're near the red zone, put on some hedges so that you can know that if the market does sporadically turn around, that you have protection for your trades. Sweet. So that is how we do that. Next, how we can automate this entire strategy so that it can be done hands-free. And again, this is what I'm doing using the options auto trader, which I'm going to show you here in a second. Now, again, I just want to be completely upfront and honest with you. I am biased. I have built this platform and I think it's the best. And I think it's the best not only because I built it, but because we support over $30 million are connected to this platform. And it's the only platform that allows the automation of futures options. Huge advantage from a return and tax perspective. Now, let's dive in and show you what it looks like. So this is inside the options auto trader. As you can see here, it shows you your account and what's going on. It shows you the different bots you have going on. But in this example, we're going to automate the strangle strategy that I just showed you. So if I click on create an auto trader, and then I'm going to click on create my own. And again, what strategy am I going to be using? With this system, I can automate any options trading strategy. But in this example, I'll be doing the strangle. So I'm going to click on strangles. From here, I'm going to do ES because I like ES the best. And like I mentioned, I like to go further out in time, so about 120 DTE. I like to sell the put, so put -1 means selling at the 10 delta level. And the call, I like to do the 5 delta level. Oops, no, 105, 5 delta. So there we go, call at the 5 delta level. So this, as I mentioned before, is how we structure the trade. I just plug in those rules into here and it will automate exactly based on how I said. Next, I structure the trade so how I want to enter it. As I mentioned before, based on my account size, about 100,000, I can do this twice a week on Tuesday and Thursday. So I'm going to say enter multiple times a week on Tuesday and Thursday. If I have a specific time of day I want to enter, I can. But also, like I mentioned, if we enter on red days, it gives us a better advantage. So I can say prioritize red days, just like that. So now I'm entering twice a week and I'm prioritizing red days. So now that I've set how I want the trade to be structured, how I want it to be entered, now I set when I want it to exit. So like I mentioned before, my take profit will be a 25% take profit and a 300% stop loss. Just like that, I plug those in and it'll follow my rules to a T. Next, I set up the buying power rules. How much money can this bot use? As we saw, it takes about $6,000 to put on one trade. So I'm going to put 6,000 so I can at least enter one trade. But if we click here on more safeguards, I can enable the market crash safeguard, which basically looks at if the market is above the Bollinger Band, that means it's likely to pull back and it'll slowly get me out of my trades. So just like that, I can enable this and that will get me out of my trades automatically when the risk for a pullback is high. So this can cut down a ton of losses just by enabling one little setting. Just like that, I have created a bot. Now it's connected to my broker and I'll just be able to automate for me. I can turn it off and on however I want, but that is how you fully automate this strategy. And again, all my returns from my broker, I've never logged into my broker to actually place the trade. All those trades were done by the options auto trader for me. So if you want to start a trial down below, you can do that. Anyways, guys, I hope you learned from this video. Whether you use the automation tool or not, you can manually implement this to start generating a reliable monthly income. And if you do, I hope you comment down below because I love hearing your success. Anyways, if you guys liked the video, I hope you enjoyed it.